Hi folks, this is Ryan Litchfield with BetterTrades. Today I was going to give you a wrap up at the end of the day, but I think I'll cover the entire week just because it's been a very interesting week to say the least. Had a lot of things here to talk about, and we'll do that very quickly. But first, let me remind you that I do not have a license to give you advice on any positions that you're trading, whether they're funded or not funded. But it is going to be education, information, some awfully good stuff I want to share with you tonight. But it is not information to be taken as advice in any way, shape, or form. You get what I mean? Now, let's talk about this. Here's the 411 on this week. We've been playing a little bit of Russian roulette, a little play on words there, but Putin has really got things in a tizzy. I'm going to stay out of the political side of this. I've got very strong feelings about it, but the fact is that the world is very, very much paying attention to what's going on over there. At least they were on Monday and Tuesday. It makes me kind of wonder this short news cycle phenomenon that everybody's got. We stay focused on the news as long as the media tells us that they want us to, it appears. And our lives are run, at least in some people's minds, by the news cycle. And whoever decides what's important, that's what everybody talks about. Well, tell you what, the world saw a very scary situation happening over the weekend with Russia moving into Crimea. And the response from the rest of the world has been marginal, shall we say, a little complicated and certainly not dissuading of Russia. Markets went down substantially on Monday when Putin announced or made overtures that, well, we're backing off. Oh, you had this huge reversal and recovery on Tuesday. And then nothing. As you take a look at what's happened in the last 3 days, Tuesday, Wednesday, and Thursday, these have been some hard-fought, slugging out, little teeny-tiny victories that don't seem to have much follow-through whatsoever. On Tuesday, or Wednesday rather, we had essentially a little doji star, and on Thursday, yesterday, had a little bit of a shooting star, and then today we've got a relative of the spinning top. It should have a little bigger body, or it could be a long-legged doji if there was no body. The message is essentially the same, but I'll tell you what, these 3 days are giving us a message that there is very little sentiment in the market to drive it one way or the other. We are at an overbought condition. We are at a holding point that makes this a very strong pivot point. Whatever happens next here will be significant, because we've got stuck for 3 days in a very tight range. Today's range eclipsed the previous 2 days and still didn't go anywhere. So there's a lot of potential pressure building in the market, as people say, although in some veins you really don't call it pressure. It's an equilibrium where you have equal buying and equal selling pressure. That's absolutely ducky for some folks. For traders who are simply trying to acquire or distribute positions, they love this. The market stays in a fairly tight range, doesn't go too far, and they're able to move stocks around without too much headwinds, without having to chase it. But for active traders, they get bored as can be when you get action like this, and so pressure builds in that context. And eventually, the buying and or selling pressure takes over in one direction, and we get an imbalance, and off it goes. So we're setting up for that, and it's a weekend, and nobody wanted to commit themselves very hard, although I'm going to share you something with candlesticks, guys. I'm a candlestick expert. I'm not going to go into detail or brag, but I'll tell you, I can talk to anybody about candlesticks. So I want to teach you something here. I'll just take a minute and give you a little lesson. When you look at any one of the last 3 days, even if you look back here on Tuesday or Monday, you cannot, in good conscience, the only way you can do this is out of ignorance. And I say this boldly, and I hope I don't offend anybody, but I really don't care because it's true. When you look at a Japanese candlestick and you tell me what it means just by looking at it, I think that's foolish. I really do. Because there's a principle that I teach that I push very hard, and that is you've got to understand the composition of the candle before you can really interpret the candle. You can't afford to just look at this and take it at face value. Let me give you an example. Okay, now take a look at the S&P here today. The S&P had essentially the width of the body is this big. This is all it is, right? There's the opening price, there's the closing price. Okay, it's almost a doji. We hit the high of the day very first thing, we hit the low of the day by about 11 o'clock, 11:15, and then we just kind of languished in the middle. Right? Well, not really. We languished in the lower half of the trade, below our opening and our closing prices. So we really were stuck in a trading range, and this shows you just a very strong lack of strength. I'm playing with words there. But I mean, this is a very indecisive, we're going up, we're going down, we're going up, we're going down. And this kind of a balance is, like I say, for some people they love it. Others, they go crazy because they want to get off of this point of being stuck and get it moving somewhere. The fact that we could not break back up above this area is pretty significant. Okay, now the overall mood in the market is still very bullish, and taking this out on Monday, pushing up above 1879 would be significant, and this would be our initial target here. But let me show you something. This could today have been a very different picture. We could have done this. We could have opened, excuse me, and dipped down first and hit the low very quickly, and then we could have moved with a lot of bullish strength throughout the day. And if we moved up like this, this would be a strong bullish signal, and we could have wound up parking ourselves above that opening price as opposed to below. It would have had a very different context, have a different meaning. There's any number of things, and of course you're going to have to learn to do your own interpretation on this, but I'm telling you that it makes a difference. This could have been this kind of a pattern where we stayed up here and then all of a sudden in the afternoon we crashed down, tried to rally back up, crashed down again, tried to rally back up, crashed down again, and wound up finishing there. And that would be a different story than what we had today. In other words, guys, the composition, when you look inside the candle and how it was formed, it can tell you a very different story. So a hammer pattern is not always a hammer pattern. At least it's not the same. It doesn't mean what you would associate with a hammer pattern. We could have done a quick bounce like we did here, highs and lows very quickly, and then could have traded down the rest of the day in this kind of a fashion so that there was a strong sell-off consistent through the day, and the only thing that stopped it from going any farther was they rang the bell. You see, every one of those variations that I've showed you would create exactly the same candle pattern. Exactly the same. Does not mean that it would mean the same. And oftentimes you can get very strong differences in meaning. And so please, take it from me. There is a wealth of information when you look inside the candle, inside the composition. All right? Now, back to the overall market picture. We're kind of twisting in the wind as we sit up here at this resistance level. Larry McMillan, who's very, very respected in trading circles, particularly in options. I mean, he's a great guy. Larry's saying go, 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 go. All the signals are there. Bullish, bullish, bullish. In spite of all the naysaying, bullish, bullish, bullish. Well, guys, the naysaying comes with a reason. There are so many charts, so many metrics that show this market overbought and extremely susceptible to major corrections. I mean, good grief, guys, we've spent how many years feeding this market on free money? Literally free money. We have built nothing. Seriously. In the dot-com era, we built companies. We got our Microsofts, and we got Amazon, and we got Google, and we've got the whole tech sector installed permanently in the fixture and the economy of the world in a way that had not been before. In the next bubble, the housing bubble, we got infrastructure. Yeah, things got overheated, but we got infrastructure. We built something. In this last run-up, since March of 2009, we've had huge run-ups in the stock market, but we haven't healed the economy, no matter what anybody says. Jobs are still in a horrible situation, and we've got this market that's run up on nothing but hot air. There's good reason to be scared about what comes next. But in that same vein, it hasn't happened yet. And just because, and I firmly believe that it's overbought and ready for a major correction, but am I going to trade that? I don't think so. I'll trade that when it gets here. But in the meantime, you trade what's on the table. You trade what's there. Yes, there's insider selling. Yes, our margin debt, guys, in 2007 it was $381 billion. Today it's $451 billion. higher than it's ever been. That's people borrowing money so they can buy stocks. Every time we've had an extreme high like this, you've had a major correction in the market. It always accompanies it. But does it mean it's going to happen tomorrow? No. Next week? Next month? 2 months from now? No. It could be 6 months from now. Who knows? Even if you're right and you're very bearish on the market, and it does happen. Let's say it happens in 3 months. Guys, in the next 3 months, you can make a lot of money trading with the market, whatever it's doing. So dance with what brung you, okay? Don't fight the tape.